My name is Andy Heggenstaller, Head of Agronomy for U.S. Seeds. I'd like to take several minutes today to talk about some important considerations for late corn planting decisions this spring. I think it goes without saying that 2019 has been an unprecedented planting season, with planting days in most regions of the Corn Belt at historical lows, along with a frequency of rainfall events at historical highs. Truly, we are outside of normal circumstances today, and many of our customers are unsure what to do. This dynamic is especially at play today in the Eastern Corn Belt, where the prevent plant date is fast approaching. At the same time, uncertainty in the market is causing commodity prices, particularly corn, to rise rapidly, causing a set of decisions that customers need to make about whether to plant that crop or to take prevent plant. What I'd like to do today is walk through a simple analysis that I conducted to provide some guidance that you can hopefully use with your customers. To do this, I used a decision support tool produced by the University. It allows for making decisions about prevent plant, giving different agronomic and economic considerations. There's a number of factors that play into the Illinois Farm Doc model, but the key ones are listed here and deal primarily with insurance factors, production factors, and expected yield and market price. I ran a couple of scenarios with the University of Illinois tool using their standard assumptions, along with a couple of factors that I modified. On the right of this slide, you can see 4 planting date scenarios for a farm in central Illinois that would have a 220 APH. For this farm, assuming that they have standard insurance package, they would be looking at about a $360 per acre prevent plant net return. And what you can notice there is the return on investments at 4 different planting dates, starting at the 5th of June and running through the 20th of June. Each of those drop at a certain rate. Where you see them flattening out is where the actual crop insurance guarantee kicks in if you were to plant. So in this example, which is assuming about a $4.50 market price, it's very clear that a June 5 and a June 10 planting date would have a return on investment likely to be greater than what prevent plant would be. As we go beyond June 10 in this example, it becomes less certain whether or not planting would be the best bet versus prevent planting. No one knows where the market is going to land, but we could make the assumption that possibly we get as high as $5 corn. I've run that scenario here, and what we see is at that point, it becomes clear that a June 15th planting for this scenario in central Illinois would still make sense. The only thing I've changed in this analysis from the previous is about a 50-cent per bushel increase in the expected market price, and we can see that the bushel per acre yield level that would be required to beat prevent plant in this scenario is only about 165 bushels per acre, compared to a factor of about 175 bushels per acre at that $4.50 level. So I encourage you or your customers to come into this tool and put in some scenarios that they think would fit for them. I want to make clear that I am not a crop insurance expert, and I'm making these scenarios just to provide some general guidance on what we might expect. What's clear is there's still some opportunity to plant some corn, especially if the market continues to rally. So the next obvious question is, could I produce the yield level that would be required to make more money from planting versus taking the prevent plant? Fortunately, Golden Harvest Agronomy has a lot of information here to help make that decision. What I'm showing on this slide is some data that we collected over 60 site years of corn planting date studies across a range of environments. And you can see how after that early mid-May period, we start to see corn yield potential really start to decline. On the right, I've converted that into percentages for those 4 planting date scenarios I looked at earlier. And what we can see is when we get to about that June 15th level, we're probably at about 75% of what our true yield potential is. So clearly, there's still some grain on the table to be made, even in June 15th. A common question also this time of year is, if I want to hit that yield potential and not have really wet corn, should I be looking at making some switches in my hybrid maturities? And I think this is another area where the research we've done at Golden Harvest can really offer some guidance. So a couple of factors that I would point to here. The first is clearly as we reduce the relative maturity of our hybrids, that yield potential declines. That's the orange line and the orange dots on this graph. What's interesting is that response is different than what the moisture response is, which is more of a curve. What that means is if we start making some moderate, let's say up to 10 RM reductions, we can harvest, so to speak, up to 10, 15% of moisture reduction. But notice then once we get beyond, assuming in this scenario that 115 is the ideal maturity, once we drop below about that 105 hybrid maturity, we continue to lose yield potential, but the rate at which we reduce harvest moisture starts to flatten out. And there's a reason for this. Corn responds to heat and day length as it determines its maturity. As day lengths start to get shorter after the solstice, the rate at which corn moves through growing stages increases by about 7 GDUs per day for black layer. So what that means is we get a disproportionately lower benefit from moving to these really out of zone adapted hybrids. And there's really not a benefit to making really big shifts. The other thing that's worth noting is in a 115-day maturity zone, if we start moving down to 95, 90-day hybrids, we're moving products into that zone that were never intended to be there, and we can potentially run into a lot of agronomic issues as well. So I'd like to summarize here with a couple of key points that I hope can be useful for you as you're having these conversations with your customers. The first point I would make, and to be clear, this is for the scenarios I ran with that 220 APH, $4.50 to $5 corn in central Illinois. Mileage may vary outside of that area. But in those conditions, planting on June 1st through 10th should be more profitable than taking prevent plant, which you could take beginning on June 6th. Planting by June 15th or at June 15th would require somewhere in the range in my scenarios of 165 to 175 bushels per acre to break even with prevent plant. Our research indicates that once we get beyond June 15th, the likelihood of achieving more than 160 to 175 bushels will be a major risk. The table below shows some estimated yields from our research by those various planting dates. The other two key points I just made were about those RM shifts. There's definitely some moisture benefit that could be gained with some modest shifts to some lower maturity hybrids that are still adapted for the growing region. That will cost some yield, but we can make up a little moisture. I'd strongly advise against, based on our data, making large shifts in RM, typically more than 10 maturity days outside of zone is going to result in less of a moisture reduction, and continue to increase yield, reduce yield potential, and bring likelihood of some agronomic issues because we're using unadapted hybrids for the zone. Thanks for taking the time to look at this video today. I guess I would just leave you to say thank you for everything you do for our customers. I think at the end of the day, one of the most important things each of us does is support our customers, especially in difficult times like this. So thank you for that, and hopefully this information can help you deliver the promise of rooted in genetics, agronomy, and service to your customers this year. Thanks, and have a safe growing season.